Hi everybody, and welcome to our last video in chapter 17, video number 12. When we left off, we were looking at this franchise example solution, and the next bullet point here, the training and services and equipment are distinct because similar services and equipment are sold separately. So TUMS satisfies those performance obligations when it transfers the services and equipment to Food Fight. TUMS cannot recognize revenue for royalty payments because it is not reasonably assured to be entitled to those sales-based royalty amounts. That is, these payments represent variable consideration. Therefore, TUMS recognizes revenues for royalties when or as the uncertainty is resolved. TUMS promised to stand ready to provide products to the franchisee in the future at standalone selling price is not accounted for as a separate performance obligation in the contract because it does not provide Food Fight with a material right. Thus, revenue from those sales is recorded in the future when sales are made. Okay, so the right to the trade names, market area, and proprietary know-how, $20,000. Training services, $9,957,000. And equipment that cost $10,000 for $14,000. Training is completed January 26. The equipment is installed in January of 2026, and Food Fight holds a grand opening on February 2nd, 2026. So now, on December 31, 2025, the TUMS is going to record the cash that it receives, $20,000. It has a notes receivable for the balance of $30,000 paid over 5 years. There's a discount on the notes receivable of $6,043, unearned franchise revenue of $20,000, and unearned service revenue for the training of $9,957, and unearned sales revenue for the equipment, $14,000. Now, when the franchise opens, TUMS satisfies the performance obligation related to the franchise rights, training, and equipment, and that is, TUMS has no further obligations related to those elements of the franchise on February 2nd, 2026. So now it's going to convert all those liabilities that it had here to earned revenue here, and reflect the cost of goods sold of $10,000 for that. Okay, during 2026, Food Fight does well, and it records $525,000 of sales in its first year of operations. TUMS then is going to record the continuing franchise fees on December 31 as follows. It takes 1% of the gross revenues, so that's going to be $5,250 accounts receivable, and credit franchise revenue of $5,250. But also to record the payment received and the interest revenue on the note, it's going to debit its cash for $6,000, crediting notes receivable here, and also we will debit the discount on the notes receivable, and that's computed by taking $23,957 times 8%, or $1,917,000, and interest revenue of $1,917. Okay, now, recognition of franchise rights over time. Here, depending on the economic substance of the rights, the franchisor may be providing access to the right rather than transferring control of the franchise rights. In this case, the franchise revenue is recognized over time rather than at a point in time. Okay, here, Tech Solvers Corporation is the franchisor in an emerging technology consulting service business. Tech Solvers Stores provides a range of computing services, hardware, software installation, repairs, data backup, device syncing, and network solutions on popular Apple and PC devices. Each franchise agreement gives the franchisee the right to open a Tech Solvers store and sell Tech Solvers products and services in the area for 5 years. Under the contract, Tech Solvers also provides the franchisee with a number of services to support and enhance the franchise brand, including Alpha, advising and consulting on operations of the store, Bravo, communicating new hardware and software developments and service techniques, Charlie, providing business and training manuals, and Delta, advertising programs and training. As an almost entirely service operation, all parts and other supplies are purchased as needed by customers. Tech Solvers provides few upfront services to franchisees. Instead, the franchisee recruits service technicians who are given Tech Solvers training materials, online manuals, and tutorials, which are updated for technology changes on a monthly basis at a minimum. Tech Solvers enters into a franchise agreement on December 15, 2025, giving a franchisee the right to operate Tech Solvers franchise in Eastern Indiana for 5 years. Tech Solver charges an initial franchise fee of $5,000 for the right to operate as a franchisee, payable upon signing the contract. Tech Solvers also receives ongoing royalty payments of 7% of the franchisee's annual sales, payable each January 15th of the following year. The franchise begins operations in January 2026 and recognized $85,000 of revenue in 2026. So what are the performance obligations of this arrangement and the point in time at which these performance obligations will be satisfied and revenue be recognized? Well, to identify those performance obligations, Tech Solvers must determine whether the promised rights and ongoing franchise technology support and training services are distinct. The rights here to trade name, market area, proprietary know-how for 5 years are not individually distinct, as the previous example. And because each one is not sold separately and cannot be used with other goods and services that are readily available to the franchisee. In addition, these licensed rights have a close connection with the underlying Tech Solver's intellectual property. That is, its ability to keep its service and training materials up to date. Therefore, these combined rights and ongoing training materials are single performance obligations. Tech Solvers satisfies the performance obligation over time. That is, once the franchisee begins operating a Tech Solvers franchise, Tech Solvers is providing access to the rights and must continue to perform updates and services. Then, Tech Solvers cannot recognize revenue for the royalty payments because it is not reasonably assured to be entitled to those revenue-based royalty amounts. That is, these payments represent variable considerations, as we did in the previous example. Therefore, Tech Solvers recognizes revenue for royalties when or as the uncertainty is resolved. Okay, We take a look at the franchise agreement. We debit cash for $5,000 at December 15, 2025, and credit unearned franchise revenue. Then the franchise begins operations. We have unearned franchise revenue of $1,000, and that's the $5,000 divided by 5, and we record earned franchise revenue of $1,000. The accounts receivable, $5,950, and that represents $85,000 times 7% for more franchise revenue. And then once we get paid on January 15th, 2027, we're going to debit cash and credit the accounts receivable. Okay, that ends chapter 17, a long chapter. And when we continue, we will look at chapter 18. Until that time, bye for now.